Welcome back to the Bitcoin Layer. I'm Nik Bhatia. Today, I'm joined by my associate, Demian Schatt. We're going to go through what has happened in the Treasury market over the last 48 hours. Demian is here to help you guys interpret all of this activity. He's here as the student asking me questions. I want to start, though, with Steve Myron's speech from August 7th. We'll be covering it more here at the Bitcoin Layer, but if you guys are confused by the tariffs, why are there tariffs being put on other countries? What is the cause for these tariffs if the stock market reaction has been so dramatic? If there's been a dislocation in the Treasury market because of it, why is this policy being pursued? Well, don't just think in terms of a tariff is a tax on a consumer and therefore the price is going to go up and it restricts free trade. That is a very narrow way to think about this issue. The broader way to think about it is that this is an agenda to reorder the global trade arrangements and potentially, as a follow-up to that, reorder the global monetary system, global banking, and the issuance of credit and currency across the world. If that is the long game here, and that is the long-term goal of the administration, then tariffs are just one piece of that puzzle, but an important first step in that search to reduce the trade deficits going on between the United States and the rest of the world. Now, remember that trade deficits are current account deficits. They also line up from the United States with capital account surpluses because as we export dollars and import goods, those dollars end up coming back and buying stocks and U.S. bonds, such as treasuries. So in that way, the U.S. has a huge current account deficit, a huge current account surplus. It's creating all sorts of distortions. It's creating a dynamic that makes 80 million people come in and vote for a trade war explicitly. And so if you want to understand the agenda from the administration, go check out Steve Myron's speech from August 7th at the Hudson Institute. We are going to link to it right here. The first few months of the new administration have sparked an unprecedented push for cost-cutting and efficiency at the federal government, but Doge can't fix the dollar. Join us on April 16th with PhD economist Peter St. Onge, who will be discussing why Bitcoin brings true efficiency to the government. With macro uncertainty causing a dip in Bitcoin prices, now is the time to understand why the world is adopting sound money. Go to unchained.com/TBL for more information. Don't write your seed on paper. It's estimated that so much Bitcoin is lost forever. And the main culprit, the main reason is poor seed phrase security. This is why we use Stamp Seed, a DIY kit that enables you to hammer your seed phrases into titanium plates using professional stamping tools. These plates are heat resistant up to 3,000 degrees, fireproof, crush proof, and time proof. They're compact and easy to hide, and they can be used in your single sig or multi-sig setups. Make sure you go check them out today at stampseed.com and use code TBL for 15% off of your order. Let's talk about rates. Demian, we'll start from wherever you want to try to interpret what has happened over the past couple of days for people.
Yeah, so starting with the obvious, what exactly was so unusual about what happened yesterday? Why was it so crazy?
Yeah, so over the past week or so, we've seen stocks come down quite a bit, right?
Mm-hmm.
And in that stock market correction, we saw Treasury yields behaving in the way that we would expect in a risk-off move. So stocks coming down is off of the back of a growth scare, right? A recession scare. How do equities have value? Well, they have earnings, right? And that's the intrinsic value of an equity, is that it has earnings, a future cash flow. Well, the expectation of those future cash flows was coming down because there was a growth scare. So in that growth scare, stocks were sold and treasuries were purchased on the other side. Why would you purchase treasuries in a growth scare? Because if yields are at 4% and you own them at 4% because you thought a combination of growth inflation warrants you to ask for 4% compensation from the government for your money, no matter what the time value is. I'm sorry, no matter what the time period is. Well, if growth is going down, then inflation will go down. You might only demand 3.5% in that scenario. So you buy treasuries at 4, you send the yields lower, the price goes up. So during the last week of price action, stocks came down and treasury yields came down across the curve, more in the front end as there were more rate cut expectations. Why would there be rate cut expectations? Because growth slowing, inflation slowing. I understand that tariffs can be a one-time price increase, but that's not what we observed in the market. We actually saw inflation expectations come down because yields were coming down. So that was expected. The drama was in the speed of the stock market correction, right? It was crashing. For a few days there, it was definitely crashing. And so yields were also plummeting. And I start there because that was expected from the cross asset correlation, the way that we try to teach this stuff. It doesn't always mean that when stocks go down, yields go down. It just means that in risk off moves, that is generally what happens. Then we got tariffs coming in to 100%, 104% on China. That knocked risk, of course, but it also caused China to devalue their currency. Now, the devaluation was minor, right? And people can go check out my video from Monday. We go over a lot of this price action and we put in context the levels, right? The Chinese yuan devalued by a little bit, and it definitely devalued past a range that it hadn't been at for quite some time. And so in that process, the market got spooked. And we saw treasury yields start to spike. Now I'm into Tuesday, April 8th price action. Okay. So Tuesday, April 8th, yields started to go up when the Chinese yuan started to devalue. So the dollar went up and yields started to go up, and they happened at the same time. And to me, the price action was looking like, hey, China's devaluing and maybe they're dumping some treasuries to get ready to defend their currency or to enact a little bit of a financial warfare here, a retaliation to the tariff announcement. That was my initial gut reaction while looking at the price action. Then, fast forward a couple hours, the Chinese yuan stopped devaluing and it actually reversed some of the move. And I'm looking at USD CNH there. CNY is the onshore rate, CNH is the offshore rate, and CNH is the one that trades in Hong Kong. So you can actually see it's a market price. So I was watching CNH. CNH reversed, but yields didn't reverse. They kept going up. And so then you have to search for another explanation. What is going on here? They started to go up rapidly, right? And then through looking at Zero Hedge and just seeing what was going on out there, and I should actually rewind a little bit, the move in swap spreads is something that we have to talk about first. Swap spreads were coming down, and swap spreads had already started to come down last week and early into this week, and that was something that was on my radar. I had discussed it with Augustine. I had actually told him, hey, I'm off the desk, but I have this feeling that swap spreads are going down right now. I don't have a terminal on the go, so I couldn't see what was happening. But I just had this feeling, the price action, that it was convexity buying when yields were coming down a lot. And I told him, in a convexity buying scenario, swap spreads will come down because they can't source the treasury. So, Damian, I apologize that I'm hopping around, but We got past the China explanation. Now I want to get into this basis trade explanation, the swap spreads explanation. So let's start at the beginning. Okay?
Okay.
There are two ways that an investor can buy duration. So if I'm talking about, I'm a life insurer,
Mm-hmm.
I have asset liability management is my goal.
Mm-hmm.
What are my liabilities if I am a life insurer? Like when will I have to pay? What is the liability for me as the life insurer? Obviously, I'm collecting premiums, right? From people. That's my cash flow.
Mm-hmm.
So what is my liability as an insurer, as a life insurer?
You have to pay for when something happens.
You have to pay for death, basically, right?
Mm-hmm.
So your liability is the death of your client.
Mm-hmm.
Now, when is the death of your client?
Probably several decades after they started the
Exactly.
life
So
insurance.
it's in the future, far into the future.
Mm-hmm.
So your liability is far into the future. So if you're generating cash flow, your assets is cash. What should
Mm-hmm.
you do with that cash? You should transform it to match your liability. So what should you
Mm-hmm.
buy?
Treasuries,
But what type?
long-term treasuries.
Long-term treasuries. So now
Mm-hmm.
I'll correct your answer. What should you buy? You should buy long duration. You
Mm-hmm.
should buy long duration. You can get long duration in two forms. US Treasury 30-year yields, 30-year
Mm-hmm.
Treasury securities, sorry. So US Treasury 30-year bonds
Mm-hmm.
or the derivatives market. Derivatives. And so what are some of those derivatives that you can buy with a lot of duration? You can buy 30-year Treasury futures, or you can
Mm-hmm.
buy 30-year swaps or 50-year swaps. And when we
Mm-hmm.
buy duration in swaps, we call it receive fixed. But I won't get into the, I won't mix up the terminology. Let's just say that you can buy duration two ways. If you're a life
Mm-hmm.
insurer, you can go buy 30-year bonds, or you can go get 30-year duration in the derivatives market, meaning in swaps.
Mm-hmm.
So swaps are a replication. They actually come from the euro dollar world. There's a whole origin story to where swaps came from, but it's a synthetic bond. That's the way to think about it. A swap is just a synthetic bond. And it's called a swap because you receive fixed cash flow and you pay a floating rate. You basically pay repo. Today, you used to pay LIBOR. The reason why that exists, it's in synthetic long, is because if you are long a treasury bond and you're financing it, you're doing so in the repo market. So you're paying repo. You're long a treasury, you're paying repo. In swaps, you're long a coupon and you're paying SOFR, which is repo. So that's why they're the same thing. It's a swap is a synthetic long of duration. So if I'm a life insurer and I can buy duration in two ways, treasuries or swaps, and I see a trade war and stocks crashing, I need duration right now. Right now. I need to get even. If yields are going down, remember, I have people going to die in 30 years. If rates are at 4% today and 3% tomorrow, I've just screwed my cash flow for 50 years, right? And so it's an urgent matter. It's an urgent matter that you have to get the duration today, especially in a growth scare and if yields are falling. So that's called the convexity move in long duration. It's basically that time is of the essence.
Mm-hmm.
And so what I told Augustine is that my gut says swap spreads today, this was probably late last week when yields were down 25 basis points, I think, at one point, that swap spreads are probably collapsing because the life insurers and everybody is just, they're doing anything they can to get long. And that means they don't have time to source treasury bonds. They don't have the time to buy the bond. They can buy the
Mm-hmm.
swap, electronically, instantly, without having to source or get a. Remember, treasury bonds are scarce. Yes, they're plentiful. Yes, there's 36 trillion in debt, but there aren't that many 30-year bonds out there. In fact, only 50 to 100 billion get issued every quarter. I don't. I think that 30s are around 30 billion a month, 20 billion a month, somewhere between 20 and 30 billion a month. So in terms of fresh Treasury 30-year issuance, it's not like there's $5 trillion of Treasury bonds out there. In fact, there's less than $1 trillion of Treasury bonds. But swaps are synthetic, so they can be printed out of thin air. It's just a trade. It's just a derivative. And by the way, these derivatives are what helped blow up the financial system in 2008. It's just synthetic. It's synthetic credits. So the Treasury buying, the absence of ability to just buy all the 30-year bonds in the world means they do what? They have to get it in swaps. And so now you think about if the swap yield was 4% and the Treasury yield was 4% going into that stock market crash. And I just explained to you that you can't really find the Treasuries. Which one would you expect to fall faster with more demand?
The swaps would fall faster.
Correct. The swaps would fall faster because of that synthetic availability that I described and the lack of availability of the cash Treasury. Cash meaning the physical security, the thing that is scarce itself. And so the swap yield falls faster. Therefore, the swap spread is falling. Because the swap spread measures how much you get in swaps over Treasuries. Well, it reversed. It went negative, and it went very negative because the demand for swaps was there. Now, what is the basis trade? The basis trade is to be long the security and short the derivative, assuming that you're actually picking up free yield. So let's say there's a repo component here, but we'll try to ignore that for a second just to make it simple. Let's say Treasuries were at 4.1 and swaps were at 4. If you expect the swap spread to remain 10 basis points, it's free money for you. You're financing at 4 and you're long at 4.1. Well, what if the swap spread changes? Then it's not free money. That's the risk, that the swap spread changes, right? So swap spread started to come down, and guess what? Everybody was long the basis trade. Everyone was long Treasuries and short swaps. So they have to close the trade. So you have to sell the bond and you have to buy back the swap. And that does what to the swap spread? It sends it even deeper negative because you have to sell the Treasury. You were long the Treasury, but now you have to get out of the trade. So you have to sell the bond that was already not enough, like not being sourced. So therefore people were buying swaps or buying their duration in the swaps market. So the basis trade is long Treasuries, short swaps. And the unwind is selling Treasuries and buying swaps, thus making swap spreads collapse. So then I was like, okay, we're past the China narrative. What's going on in swap spreads? Zero Hedge is tweeting 3-year swap spreads collapsing. I said, oh my God, this is what they've been warning about, actually. Shout out to Zero Hedge. It's you and I, Demian, have talked about this a lot. Demian is now a subscriber of their pro service because I want him to read. I want him to learn. That's why I made him do it, right? So I, on the company account, he's reading that stuff too. And yes, it's a platform for a lot of people to get their opinions out, but he himself is an analyst that has taught me many things for 15 years. It's crazy to say that out loud, that I've been reading Zero Hedge for 15 years, but I have. It's the original reason I joined Twitter, because I was like, wait, he tweets too, and I don't want to miss learning opportunities. If I'm just on the website getting an article every 1 to 2 hours, but he's tweeting every 5 to 10 minutes, I'm missing something. So I joined Twitter. It's a true story. So people can go check out his, if they want to subscribe to his thing and read that article on the basis market, but the basis trade. But yes, that is the narrative that I then landed on, that this is actually potentially the basis trade blowing up. Somebody that was long treasuries, a bunch of them, and short swaps has to unwind and sell treasuries. The move up in treasury yields last night was shocking. Because it was the only thing moving. That's also the crazy thing, because I watch all these markets together. It's not like stocks and Bitcoin were just epically crashing. They were moving. Even 2-year yields were moving, but 10s and 30s were the only thing that was doing this. And swap spreads at the same time. That told me that this was more specific. So was it China dumping last night? That's not what it felt like, because the Chinese currency wasn't moving. The dollar wasn't moving. The whole yield curve wasn't moving. Stocks weren't really moving. Asian stocks are moving because Asian investors are not liking no dumping. This is go back to the Myron speech. It's all about dumping in terms of the first order things that they're trying to address. I've discussed this on the channel too. It's not that Vietnam taking it to zero fixes everything. They are devaluing their currency all the time, like perennially. So you can't, that's called the non-tariff cheating that the administration is accusing. It's not just tariffs. It's all the other stuff, including currency manipulation. So when I was looking at the market last night, it very quickly felt like, oh, that whole China thing, that's not what I feel is happening at all. That this has to be something to do with the basis trade. Now, the most fascinating, actually the confirmation, we got it this morning. We're lucky, Demian, because whatever your political alignment is, we have a Treasury Secretary right now, Scott Bessent, that is very, very experienced. And he doesn't seem to be the type, or that might be naive to say, but I'm listening to the words that he's saying and processing them as a financial practitioner, not taking them in as propaganda. So that's what I'll say. I don't want to say that I think he's lying or I don't think he's lying. I think, yes, my gut is that he's telling the truth, quote unquote, but more so that he's talking as someone with asset management experience. I'm listening as someone with asset management experience and just taking his word for what he's saying. So I think we're lucky to have a Treasury Secretary like that really is brilliant and experienced. He helped Soros break the pound. So we're talking about someone that has been involved. He has also said that I want to be the architect of Bretton Woods too. This is a real thing that he has said. This is wild. You guys have to understand, this is wild. We are living in a crazy, we are lucky to live through this transition. Bretton Woods happened in 1944. That's 56 plus 25. It's 81 years ago. So we're in a once in 81 year type of environment right now. Freaking enjoy it, okay? I want to say that. And you have a narrator, Scott Bessent, who is not insulting my intelligence when I listen to him. Okay, so that's something that we can, like Janet Yellen, every time she opened her mouth, it's just like insulting my intelligence, because I know that you're speaking with it's an agenda. That's the only thing that can come out of your mouth. So I know that you haven't even asked your first follow-up, Damian, because this is so important. I want people to really understand the basics here. So, what did Scott Bessent say to confirm all of this? He said this morning that some deleveraging in treasuries is okay. What does deleveraging in treasuries mean? It's the basis trade. Because by definition, the basis trade is long the treasury, financed through repo, meaning a free long, against a free short because I told you the swap is synthetic anyway. So you got a little margin here, a little margin there. It's a leveraged trade. You're not actually trying to pick up 4.1 over 4. You're trying to pick up 4.1 over 4 times 50. Times 50 because you only have to post 2%. These are rough numbers, but the illustration is key. So Besant confirmed it was the basis trade unwind with only using the word deleveraging. That's my interpretation of his word. So hopefully I've answered a few of your starting questions, and I'll let you take a second to now get to the next one.
Well, just based off what you said, is this leverage harmful to the market? Is that why Scott Bessent was speaking about deleveraging the Treasury market?
So it's harmful insofar as what happened yesterday. Was yesterday harmful? Is it harmful for Treasury yields to go up 60 basis points in 48 hours? Is a dislocation like that to the Treasury market worrisome and confidence shaking and disruptive to volatility because it introduces volatility? Volatility itself is the uncertainty that market makers don't come to play and they just step back. They don't answer the phone. They literally don't answer the phone. So you try to sell them a Treasury last night and they leave you on unread on the IB. And they're like BRB and that's what happens when vol is introduced to the market. Because it's not him saying BRB. His boss said, "Hey, don't buy anything for the next 2 hours until we can figure out what the hell is going on." So is that healthy, Demian? I would argue that dislocations in the Treasury market are not healthy. It's not good or bad. It's what kind of world do we live in? Do we live in a world where markets are healthy and functioning and there are market makers that are in there to make markets? Or, and this is actually what we have, or do we live in a world in which the synthetic creation of credit is so easy that it encourages, and by the way, these banks, they call their client and say, "Hey, I got a good trade for you. Put this basis trade on." So they're the ones that are pushing it anyway because they make fees on the swap, they make fees on the long, they make fees on the repo. And they're like, "But you can do 4.1 over 4 times 50. So you get 5%. We'll take a few basis points along the way on fees." And everyone's happy. So is that the world we live in? It is. It is. And so what does that create? It creates bubbles. It now creates localized bubbles, like a basis trade bubble, where you have all this concentrated risk, and it's all synthetic. So when it unwinds, it just causes like a huge capital loss for somebody. Who went bankrupt last night? I don't know. Did somebody? We don't know. Maybe we'll find out in a day, in a week, in a year. The Fed will write a paper on it. Maybe we'll find out. The Fed will write a paper on last night. They're going to have to. These are too dramatic of things to happen, and they have to address financial stability broadly. So these dislocations where Treasury yields go up by 60 basis points for 48 hours, it's insane. And I would argue that is not a healthy market, but it's a function of our credit system. Damian, you've read Bitcoin Age. The book is about explaining how the credit system is dominant and is unlikely to go anywhere and is actually institutionalized by the banking cartel itself through their system of central bank backstops as well. So that's part of why I wrote the book. I want people to have that framework for explaining why the basis trade just pops out of nowhere and is a huge bubble, and then it bursts and causes a lot of capital losses and uncertainty and volatility.
How does the Fed, or how will the Fed decide what to do right now? if we have stocks down and yields going up, how are they? Are they watching prices? Is it a bigger signal they're
Yeah,
chasing?
it's a it's a great question. So first of all, I will say that the Fed is probably still on wait and see,
mm-hmm.
even though they have been biased to explain to the market that they want rates in the 3 handle, not in the 4 handle where they are currently. So the bias is to get them down, but that's just
Mm-hmm.
because they're only in the 4s because inflation went to 9, right? If inflation never went to 9, they would have never been in the 4s. If inflation had gone to 4, they probably would have maybe got to 3 or 4, right? So they only went to the 5s because inflation got to 9. So they want to be in the 3s because 4 is too high for anything normal for them from their perspective. So that's the baseline. That has nothing to do with tariffs. It really has nothing to do with growth or inflation, because inflation only above 5 is the worrisome thing for them. It's clear that like inflation near 4 isn't that big of a deal. If it was, they wouldn't have been cutting, so early and all of that. So, 5 was too much. 4 is still kind of too much, and so they want it in the 3s. That's like a basic way to think about it. Now, how is the Fed going to react to all of the stuff that's been happening? That's a big question mark. I don't know. They have a dual mandate, right? Employment and inflation. We have to assume that employment is ranked 1 and inflation is ranked 2. Now we have the stock market, which is the secret or, closeted third mandate, but that's really financial stability itself. So stock prices are part of financial stability, because when stocks go down, it's an introduction of volatility again, which is the market maker not picking up the phone or saying BRB on the chat. So when we have financial instability, that mandate goes from number 3 to number 1. Okay, so part of your question is if stocks are crashing but yields are, well, if yields are going up a lot, that is going to have a lot of bond volatility. So we've talked about the MOVE index.
Mm-hmm.
And Demian, you and Augustine, you guys can get a couple charts together for this episode for the viewer here, because I know you guys are working on mean median mode today for the TBL pros. People can go check that out at thebitcoinlayer.com/subscribe to become a pro and to get all of our quantitative reports and research. Look, and you struck the chart, this week we did that together. That look at MOVE and look at Bitcoin. You overlaid them, but forget Bitcoin for a second. Just look at MOVE. It's going haywire. It's going haywire. And so that is financial instability. MOVE going haywire is financial instability. We had Harley Bassman, the creator of the MOVE index, this morning tweeting about it. So he's on Twitter at Convexity Maven. People can go check out his work. I'm lucky to be the mentee of Harley Bassman's mentee. He taught me everything I know about derivatives, really. The MOVE index itself is a big, big problem when it gets out of hand. So that's why Besant saying deleveraging is okay and healthy is interesting, because it means that his mandate is not to get the MOVE index down necessarily, or he's not worried enough about where it is right here. Now, the Fed, I promise you, they got a little bit worried about MOVE over the last couple of days, because dislocation and they want to make sure market makers are doing their job. And when the Fed intervenes, it's when market makers are not doing their job. So the Fed has to be like, okay, we're here to play, and we can backstop your activity a little bit, or we can endorse it, we co-sign it, right? So when volatility is in play, the financial conditions mandate, which is not even stated, and it's kind of the secret one, it becomes very clearly the first one, and publicly. We can go back to Silicon Valley Bank and what happened in the spring of 2023 as an example, where the second you get it, you get a joint statement from Treasury and Fed and the European Central Bank or something like that, or the Swiss National Bank at the time, because it was Credit Suisse that was going under. So the Fed must be looking at potential stock market crash and potential bond market volatility spikes and be on standby. The standby is the balance sheet, though. It's not really rates. It's the balance sheet, because it's the quantity of money creation that can endorse a lot of that market making to resume. So it's confidence. And it has the balance sheet as its tool there. Now you go to the two, mandates, which is employment 1 and inflation 2. Well, if employment is threatened by the trade war, the Fed is probably going to cut rates. Now, the other mandate, which is inflation, are tariffs inflationary? On the surface, tariffs are a tax hike on the consumer. And now, if you would assume that there's a substitution effect where goods can be purchased from another place that is not tariffed and mitigate the price increase, there's a potential for that. There's also the potential that the currency devalues on the other side, meaning, let's say, China devalues by 100%, then 100% tariff is mitigated by the deval. So there are ways to mitigate the price increase, but in the first order, a tariff is a price increase. So they have to be looking at that and be like, well, that's inflationary. But my best way to answer your question is that the inflationary impact of tariffs is probably quite low on the list for the Fed, underneath employment, if people get fired because of all this, because of economic uncertainty or recession. And all of that is probably under the VIX, which is the volatility of equities, which is in the 50 to 60 range. I move this over so I can get these candles. I got all the candles, Demian, because what a time. VIX has fallen quite a bit today, down to 40, and it hit 58 in the overnight session, early this morning. And it was above 60 on Monday. 60.13 is where I have the VIX printing. So at the bottom is tariff-induced inflation, because I really think that that's the last on their list. Next is employment. People getting fired, that will worry them and cause them to cut rates. VIX, equity volatility, and then MOVE, which is bond volatility. If those things stay elevated, you can expect the Fed to get involved with their balance sheet, and quite quickly. Now, I'm not calling for QE here. That's important too. I'm not calling for QE here if Treasury yields went from where they are right now at 4.38% down about 12 basis points from the overnight highs at around 4.5. If those went to 5 in a week, first of all, stocks would be crashing in that example. Okay, in my opinion, it's just an insane amount of volatility. I mean, you can't stomach that type of volatility if you're the Fed. So you just do QE. It's like a lock even at this point, because when the market, you have to understand that we're laughing about this BRB thing, but it's real, because the guy making the market, if he won't answer the phone, everyone is dead. Everyone is dead. The guy trying to sell his treasuries is dead. Think about the corporation that needs to issue bonds next week to pay their maturity. I mean, forget building a factory. That's not what they do. They just roll the debt. most of it just goes to the old coupon, and they do the cash clear out, and they, sweep up all the existing bonds because they've issued the new ones. And, 80% of it goes to pay down old maturities and buy back some stocks, and then they start investing and hiring some people. Everything stops. In COVID, you went no issuance. It means that no corporate bonds are issued. And that's death. I mean, because if the corporate can't issue, he's dead. His maturity's tomorrow. So he's dead. It's a default if the bond market is closed. Treasury yields go to 5, everyone's dead, and it's a QE, it's a lock. It's not even an if. And we know it's not an if because we have too many examples now. The Fed has established this framework for 15, 17 years now, the QE framework, and what they're going to do when this happens. So right now, I don't expect that. Last night was scary. I mean, scary from the perspective of, man, I wonder if Jerome Powell is awake right now. And I had that feeling yesterday that I wonder if Jerome Powell is awake right now, or if somebody pinged him, like he had gone to bed and they were like, "Hey, can you just turn your terminal on, and just can you just keep your eye on that? Don't turn your ringer off tonight." So yeah, I got that feeling yesterday, and so that's wild. That means we're in interesting times. We're in that borderline QE any second. You're there, but it's still not my base case, right? I'm going to use price. Yields got to 4 3/4 a couple months ago, really recently, and they've come down a lot since then. So they're at 4.4. They were at 4.75. So is that an all-out panic zoomed out? No, it's not. Last night it felt like a panic for sure, but that's maybe because somebody went under last night. Some hedge fund or somebody that was long the basis trade, they just got liquidated. And so I hope that answers your question on the Fed's reaction function.
Mm-hmm. So overall, you think the possibility of recession motivates Powell more than tackling inflation?
Oh yeah, that's not even a question, because the inflation, Demian, it's not in the 5s. It's not in the 4s. Wages are actually now back into the 3s, and consumer is in the 2s. So no, and they can't act on policy, or they can't make policy moves based off of, we think there's going to be some tariff-induced inflation. Mm-hmm. The 9% inflation was in 2021. It's a really long time ago. Mm-hmm. I'm not saying that people are experiencing falling prices on the street. The Fed has their statistics to make it all look, not that bad. And I just don't see that. I don't see them worried about that. Mm-hmm. If the data, right? We watch CPI. So if the data, or even inflation break-evens on treasuries, if the data suggests it, there is, then they can talk about it. Mm-hmm. But it does seem to be low on their list.
Mm-hmm. So do you think it's really uncertainty then? I'm just wondering how tariffs end up shaking up markets so much.
The tariffs, like I said at the beginning with the Steve Myron speech, it's a reordering of a 50-year problem. So the volatility that gets introduced, you have to expect that they workshopped this. And they had their levels on the S&P 500. that they said if it gets below that, then we'll have to roll out some walking back of the narratives. And so I think that all of that is important. And that's just the way that they're thinking about it.
Mm-hmm. And then tying it all back to Bitcoin, why do you think it's holding up right now relatively stable compared to the stock market downturn?
Absolutely. And I should say here that I saw my candles moving, so I had to go to the internet and see. Trump announces a 90-day tariff pause for at least some countries, but still raises China's tariffs to 125%. So this is bouncing stocks. It's going to, cause yields to come down. Volatility is coming down. Bitcoin is pumping a little bit off of this news. So this is just what we're talking about, right? They're going to respond to certain things, and the reordering agenda, it does seem to be very China focused, very, very China focused. And so this headline makes a lot of sense. Why is Bitcoin holding in so well? This is the most incredible thing that I've observed during this current cycle with the type of volatility that we've seen. I'm not shocked, but I'm so surprised that Bitcoin held in. It's still above 80,000 today. And that just has to be the awareness of Bitcoin as a global reserve asset. Remember that you have real estate at 300 trillion, gold at 20 trillion, and Bitcoin at less than 2 trillion. So if it's in the same conversation as gold and real estate, and it's less than 1/10 the value of gold, and less than 1% the value of real estate, there's an arbitrage there still to be had, and it's the realization, it's the understanding, it's the awareness, it's the access now with ETFs. It's the endorsement from the US government. Also, there's an awareness, there's a bid underneath the market, and it's scarce, and it is Caitlin Long would absolutely she would murder me for saying this. It is avoiding the paper manipulation, because if it wasn't, you wouldn't see this type of price action hold in. So I hope people can, understand that Bitcoin price is actually holding in very well, all things being considered. I had a statistic that during the COVID month, stocks went down 12% and Bitcoin went down 30%. Well, as of that moment when I tweeted it, stocks were down 12%, Bitcoin was down 5%. And that's remarkable. And so I hope that people can see through some of the volatility and recognize the positives, even though there's a strong correlation of Bitcoin to stocks, and there's a strong relationship between volatility and these risk assets, meaning that volatility up will move these assets down, but it has held in very, very well, all things being considered. And you might look at Bitcoin down 30% from its all-time high and say I don't really buy that, and that's okay. But we can, you can run back to previous cycles and see that 30% drawdowns are quite modest for Bitcoin.
Mm-hmm. Our first look at Bitcoin being a safe haven asset at some point in the future.
That's really what you can read between the lines, even though it's still, relatively weak alongside stocks over the past week or so. So thanks for helping us walk through some of these things, Damian. I think it's a nice way to explain things is to have a student that's really trying to gather the information and put it all together. So we appreciate you guys. With Demian Schatt, I'm Nik Bhatia at the Bitcoin Layer. We'll catch you guys next time.
See you guys.